Hi, everybody, and welcome back to video number 2 in chapter 15. But before we continue with overhead costs, I wanted to make a couple of points. First of all, um, if you see down here, we have speaker notes on some of the slides. Those are very helpful, I think, in helping you with your studies when you're not listening to my video. The other point I want to make too is be sure you actually read the chapter. The PowerPoints give a good overview of what's in the chapter, but reading the chapter will solidify your understanding of the subject matter content. Anyway, back to our video. Okay, overhead costs. You'll remember that we briefly talked about material, direct material and indirect material, and labor, direct material or direct labor and indirect labor. Indirect labor and indirect material are part of your overhead costs, along with other overhead items such as rent, uh, air conditioning, um, et cetera, et cetera. So here, at the beginning of the period, we're going to set what we call a predetermined overhead rate. Very important here. How do we get that? Normally, we're going to take our estimated overhead costs, underscore estimated, and divide that by our estimated activity. Usually we're going to use labor hours, but we don't have to. We can use machine hours. We can use labor dollars, any reasonable activity from which we can allocate these overhead costs. Now, what do we do with this predetermined overhead rate? We apply that as we're manufacturing our product. We will apply the predetermined overhead rate to the actual activity that we use, the actual activity base. So if it's labor hours, we'll multiply those labor hours times or dollars times our overhead rate, and that will give an estimated overhead. And then during the period, we will record our actual overhead and compare it to the estimated overhead and close that overhead account. So this is a little complicated, so let's go through it. Here, Road Warriors uses predetermined overhead rate, the POHR, based on direct labor cost, direct labor dollars, as I call it, to apply overhead to jobs. So here we have our estimated overhead costs. We divide that by the estimated overhead base, in this case, direct labor dollars that we expect, usually over the year. Now, we think that we're going to have overhead costs of $200,000 and we're going to have $125,000 of direct labor costs, which comes out 160%. So we're going to multiply that 160% times our actual direct labor costs. So here was our direct labor cost, which we did in the prior slide, if you'll remember, for $4,200. Now we use that predetermined overhead rate of 1.6, 160%, and multiply it through times the direct labor costs to get the applied overhead. Applied. So here we did it by, we're going to put this much overhead in each one of these jobs. Total is $67.20. And when we do the journal entry, we'll debit work in process inventory to increase it and credit factory overhead. That's going to be a credit to factory overhead, and you'll see how that works here just in a second. So there we're applying the 160% of direct labor. Now, let's look at our actual overhead. Again, we have indirect material, indirect labor, and other overhead costs in what I call the overhead pool. Okay, now we record the indirect materials we use by taking them out of raw materials inventory and putting them into our factory overhead pool. We do the same thing with our indirect labor. We put them into factory overhead, or we should say we're going to debit factory overhead and credit factory wages payable for that indirect labor used. And you can see here that we also have some other overhead costs: factory equipment accumulated depreciation, rent payable, utilities payable, and prepaid insurance. These are our actual overhead costs. You'll notice that this is a debit to factory overhead. Now, if I go back a few slides here, you will notice that when we estimated our factory overhead and applied overhead, it was a credit to factory overhead. In this case, 6720. But we have applied 5270 here of other overhead costs. We did that with a debit, and we had another 1100 for indirect labor and another 550 for indirect materials. Okay. So now here is a diagram of the cost flows to the financial statements. Here we have our beginning purchases, and that's going to be the materials available. We're going to move some of that to work in process inventory, keeping the rest in raw materials inventory. Here, we're going to do the same thing. We have beginning, work in process inventory. We add direct material, direct labor, and applied overhead. And that'll give us the ending raw work in process inventory when we move the cost of goods manufactured into finished goods. One of two things happen to that finished goods inventory. Either we sell it and we have cost of goods sold, which reduces finished goods inventory, or we keep it and it becomes ending finished goods inventory. And that's how cost of goods sold gets into the income statement in a manufacturing company. Okay, you'll see there's a delay here. It stays on the balance sheet in work in process inventory and raw materials inventory and finished goods inventory until it's sold. When it's sold, that's when we recognize the costs on the income statement. So there's a little bit of a delay based in that. Now, this is a great slide. And here, let's walk through this in a little bit of depth. Here, we had a beginning inventory. We added materials that we purchased here. But in number 2, we moved some of the raw materials here into work in process inventory. But we also moved some of that raw materials in the form of indirect materials to factory overhead. Then we had other overhead, that's our rent and our insurance and other kinds of things like that. And that goes into the factory overhead pool too. Then we have our direct labor, and that goes into our work in process inventory. And the indirect labor goes into the factory overhead pool. We add all that up, and then we moved $67.20 when we applied that overhead in work in process inventory. We moved finished goods. We moved that cost of goods manufactured into finished goods inventory. And then one of two things happen to that finished goods inventory. Either it is sold here in cost of goods sold, or we keep it here in finished goods inventory. Okay, so now that splits those jobs now, each of which have materials, labor, and overhead applied to them. And if we take that applied overhead here of 1920, 3200, and 1600, you'll see that it totals the 6720 here of applied overhead. Now, you'll notice here that we have a $200 debit balance in factory overhead. You'll see how we eliminate that in just a second, because at the end of the month, we want this factory overhead account here to have a zero balance. Okay. So here's a summary of all our journal entries. Here we've acquired some raw materials, pretty straightforward. We've had some direct materials that we used, so we moved that into work in process inventory. Here's some direct labor that we used. We moved that into work in process inventory and credited factory wages payable. We have some indirect materials that we use, and we move that into the factory overhead pool and out of the raw materials inventory. And here we have some indirect labor that we use. We're going to move that into the factory overhead pool and credit factory wages payable. Then we're going to apply overhead at 160% of direct labor. So we take the direct labor now and multiply it by 160%, and that gives us a debit to work in process inventory and a credit to factory overhead. That's where factory overhead gets reduced here, when we apply that overhead against the actual overhead, which we've had here and here. Okay. Then, and for that matter, here. So factory overhead then is combined with, we had accumulated depreciation, some rent payable, utilities payable, and prepaid insurance. That's all the other factory overhead. Those are actuals. And so now, when we move jobs completed, which were jobs 15 and 16, when we complete those jobs, we move them into finished goods inventory and out of work in process inventory. And when we sell that job Bravo 15 here, we're going to debit cost of goods sold and credit finished goods inventory. That will reduce finished goods inventory. And what's left in finished goods will be our finished goods inventory that we will report on the balance sheet as ending finished goods inventory. Now, finally, we sell our job B15 here for $5,500. Our cost of goods sold was $3,300, so we made gross profit of $2,200 on that. This is a lovely slide summarizing the cost flows and the journal entries associated with them. That looks like a good place for us to stop this video. And when we return, we'll take a look at the schedule of the cost of goods manufactured. Until that time, bye for now.